Welcome to another video, and this week we are looking at the weekly macro themes report once again, and this is a report that we produce for our clients, and this is the front page of it here. A few interesting topics there. This is from a couple of weeks ago. Global growth and the inflation reset, US dollar, what next? Putting market cap into perspective, Australian equities, alternative views on global equity valuations, which is a particularly interesting topic. But this week we are going to be looking at this one here, number 3. So let's head down to number 3. And that is putting market cap into perspective. And we'll start with the bottom line. When you put market cap weights into perspective against earnings weights, it dissolves any notion that now is like .com, like the .com boom. And that's probably one of the key takeaways from this piece of analysis. But aside from honing in on the IT sector, which we'll have a look at a little bit closely second, the first one I wanted to show you is just a view of some of the sector weights, or the market cap weights, and it shows, I guess, really some of the key sectors that have been through sort of, you might want to call them bubbles, or at least certainly big moves in their market cap representation in the S&P 500 index. So the first chart here, we've got the information technology sector, the energy sector, financials, and healthcare. These are the GICS sectors, or GICS. Now this is market cap percentage weight or market cap representation. So the market cap of that sector divided by the total market cap of the index. You can see here the first one that stands out is information technology. The .com boom really was a boom driven and concentrated by one sector. You can see that information technology went from about a 10% weight to more than 30%, and that was very much short-lived. And this is probably where we jump to the next chart and look at the sector earnings weights percent. So this is pretty much the same approach, but looking this time at the earnings of that sector divided by the total earnings for the S&P 500. And the first thing you'll probably notice there is the information technology one. Now, in that same period, it went from a weighting of about 8% to about 17% there, or even 15%. Really, not even more than 20%. So there was quite a disconnect at that time between earnings weight and market cap weight, and that was probably really the key giveaway in that respect. But you'll notice if you look at that grey line through time, there has been, rather than a spike that we saw during the .com boom, there's been really just a steady uptrend. So it's more of a structural shift there rather than a cyclical swing. Energy is probably the other one that sticks out on that chart. We had that big spike in oil prices, and that drove up earnings for energy companies, and you can see that their earnings weight rose to a very high level. And then by the same token, when oil crashed, their earnings share went down very low, just like the financial sector did in the wake of the financial crisis. So it can be quite revealing, quite interesting to monitor the trends of earnings percentage weights in the index. And then if you look back at that market cap weight sector chart again, looking at the orange line, the financials line, you could potentially argue that there was a bit of a bank bubble, or certainly the credit bubble that we saw prior to the crisis helped banks become the biggest weight on market cap and the biggest weight on earnings by far. And of course the energy bubble there, as I sort of mentioned there, you can see that it went from around 5%. Energy went from about a 5% sector representation on market cap up to 15% at the peak, and now it's back almost at that 5% level, which you could probably get a bit of a signal from that. But probably the main takeaway from that chart there is that there's nothing really that's really sticking out on there. The information technology sector is the highest weight, but then this is probably actually a good time to look at the next set of charts. So the first chart here shows market cap representation and earnings representation for the information technology sector. And you can see that disconnect that I mentioned at the height of the dot-com boom, it's very stark there. And then again, what I mentioned about the sort of structural uptrend in earnings for that sector, you can see there that it was actually matched. They're sort of moving one for one in many ways there, to the extent that market cap representation and earnings representation are actually at the same level. So it's a very, very different story from the dot-com mania. Yes, there's definitely some excitement about the sector, and in absolute terms, valuations have risen, along with the market itself. But at this point, it's not a pie in the sky thing. There's actually earnings coming through, and there's several technology companies now that are actually quite more mature and almost look like the way industrials did back at the dot-com time. And so that brings us to the second chart there, the valuations aspect. And this chart shows the information technology sector forward PE ratio, price divided by next 12 months estimated earnings from the Thomson Reuters data stream IBES data. And it also shows in the black line there the S&P 500 forward PE ratio. And you can see that they're actually moving, pretty much in sync there lately, versus at the height of the dot-com boom. There's a wide gap there. So the red line there shows the discount or premium between those two valuation ratios. You can see there that there was, virtually 100% premium. So they're trading twice as expensive as the index. Now lately it's gone from, there was actually a bit of a discount. So the IT sector was actually trading at a discount back in around 2013. But now it's fairly neutral there. So in that respect, in absolute terms, along with the rest of the market, it's not cheap. But then it's not really trading at a premium to the market. So, there's not a relative valuation case either way there really. So, there's been quite a lot of hype around the so-called FANG stocks, but if you peel back the layers and look at the data, you can see that any parallel that people try to draw to the dot-com mania, it's nothing like that. Certainly you could say it's nothing like that yet. Maybe it will get like that, but the data and the charts will show if it does get like that, and that's something that we'll be looking out for. So I'll just leave it there at this point, and if you have any questions or comments about these, please put them in the section below on the YouTube video, and be sure to subscribe to the channel for future updates.